In this lecture, we're going to work through problems SF-112 through SF-114 in your book, so you can follow along. So basically, we're going to be constructing financial statements given the account balances that are given in the example. So we're going to first start with the income statement. So up here we have our header information. So the first thing we're going to do is put the name of the company. So in this case it's Amazing Arrangements. Next thing we're going to do is put what statement this is. So in this case we're doing the income statement. And then the last part of this header is basically the time period. So we have a couple of options here. So we have a particular date, December 31st, or we have year ended December 31st, 2024. So if you'll remember, the income statement is tracking the inflows and outflows of the business across a particular period of time. So December 31st, 2024 would be incorrect because this is just stating one day. It would just be the inflows and outflows for this particular day, but that's not what we want. We want to see what the income and expenses were for the entire year. So we got to make sure we label this correctly with the year ended December 31st, 2024. Okay, so now let's see the account balances. So we see here all of our different account balances. And so the challenge of this particular question will be which of these accounts are going to go on the income statement. So the basic calculation of the income statement is revenues minus expenses equals net income. So if we look at these, we notice that some of them are revenues, some of them are expenses, some of them are assets such as cash, some are liabilities like accounts payable. So we have to separate the revenue and expense accounts, and those will be the ones that we're going to include in the income statement. So at the beginning, at the top, we're going to have our revenues. And we see here that we have service revenue. Service revenue of 72,000. Okay, so that part is done. I looked through the list. I don't see any other revenues. So now let's list the expenses. So at the top here we have insurance expense of 1,000. Utilities expense of 1,000. Rent expense of 9,000. Okay, what else? Anything else? No. Common stock? No. That's going to go on the balance sheet. Cash is going to go on the balance sheet. Retained earnings is the balance sheet. Okay, so salaries expense. Here we go. 37,000. Accounts payable? No. Office supplies? No. That's an asset. Okay, so I think we have all of our expenses here. So we're going to get a subtotal. So this is going to be total expenses. And so when we add this up, 1,000 plus 1,000 plus 9,000 plus 37,000 is, let's just do the math real quick here. 37 plus 9, 48,000. So now our net income is simply our revenues minus our expenses. So 72,000 minus 48,000 is 24,000. So let's see how we did. Okay, we got everything right. Okay, so our next financial statement that we're going to put together is the statement of retained earnings. So let's see what information they're going to give us. So we again have our account information, and we also have our income statement. So let's go through the header again. So again, we're going to have our business name. We're going to have the name of the financial statement, statement of retained earnings, and then we're going to have the period. So again, statement of retained earnings is another financial statement where we are tracking what happened across a particular period of time. So we're going to have the year ended December 31st, 2024. So retained earnings, the beginning balance, we look here and we see that our retained earnings balance at the beginning of the year was 5,100. Okay, so what this statement is basically going to show is we take our beginning balance, we're going to add net income, which is what we earned over the course of the year. We'll get a subtotal. Then we're going to subtract the dividends, which are basically payments out of the business to the shareholders, the owners of the business. So we have to subtract that out because that money is basically being removed from what the owners own and distributed to them. So it's no longer a part of the business because it's been paid out to the individuals who own the business. So we have to subtract that out. So, and then we get our ending balance for the end of the year. So let's go through those steps. So we have net income for the year. So we see here that it's 2,100. So if you see in the options, we could have had a net loss. In this case, our revenues exceeded our expenses, so we have a net income. So it's going to be net income for the year 2,100. So our subtotal is 7,200. And then we have to subtract out our dividends. And where do we get dividends? We look here. It's 4,800. So in the statement of retained earnings, if you're subtracting a number, make sure to put it in parentheses. And so now we have our starting balance plus our net income. And then we have to subtract the amount of dividends, the amount of this 7,200 that was paid out to our shareholders. And so our total ending balance is 7,200 minus 4,800 is 2,400. Okay, so let's see. Okay, we got it. And finally, we have our balance sheet here. So again, we start with the header, name of the business, name of the financial statement, the balance sheet. And now the balance sheet is different. Remember, the balance sheet is taking a snapshot on a particular date at the end of the period. So instead of using year ended, which implies a period of time, we're going to pick a particular date. So the balance sheet is going to be as of a particular date, in this case, the end of the year. So it's just like checking your wallet. You don't say that I have $100 in my wallet between January 1st and December 31st. Instead, you say I have $100 in my wallet right now. At this particular time, this is what I have. So that's what the balance sheet is showing. It's showing at a specific point in time what the company owns in terms of its assets, who it owes money to in terms of liabilities, and then based on what the company owns minus who it owes and what it owes, you have what's left over for the owners. So keep that in mind. So it's going to be a particular date, the end of the period. So let's open up our information. So we have our account balances, we have our income statement, and we have our statement of retained earnings. I'll keep those to the side for now. So let's start with this account balances. So what are our assets? Insurance expense, no, that's already been in the income statement. Revenues in the income statement. This is also, okay, so we come down to cash. So the first asset that we're going to list is cash of 5,400. What else do we have? Office supplies. Of 1,500. Accounts receivable. $7,500. And we have equipment of 29,200. Okay, so when we add all this up, what do we get? Let's do the math real quick. So we have 400 plus. So I'm getting 43,600. And this is going to be total assets. Okay, so now let's move on to liabilities. I see here the only liability I'm seeing is accounts payable. $23,000. Okay. And then our equity accounts, we're going to have common stock of 8,000. Okay. So when we look through all these accounts, we now notice that every one of these accounts is included in one of these three financial statements. So we want to make sure we're not double counting. Okay, so insurance expense, that was in the income statement. Revenue, income statement. Utilities expense, income statement. Rent expense, income statement. Common stock, we just put on our balance sheet. Cash, we put on the balance sheet. This starting balance, look at the date. The date is very important. January 1st. This is as of December 31st. So this beginning balance is actually included in our statement of retained earnings. So that is in this statement. Salary expenses are in our income statement. Salaries payable, we put on our balance sheet. Office supplies, balance sheet. Dividends. This is also included in the statement of retained earnings. So we want to make sure we're not going to mistakenly put it into our balance sheet. Accounts receivable is in our balance sheet. Equipment is in our balance sheet. So we're missing one thing in this balance sheet to complete it, and that is basically taking the ending balance of our retained earnings, which we calculated here. So we have retained earnings of 12,600. So if you notice, you have to do these financial statements in a particular order. You start with the income statement because the income statement gives you a net income. The net income then flows into the statement of retained earnings because you have to add the net income to your beginning balance of retained earnings and then subtract out your dividends to get your ending balance of retained earnings. And then you finally need your ending balance of retained earnings to complete your balance sheet. So now let's make sure that our totals add up. So let's see here. 23,000 plus 8,000 plus 12,600 is indeed 43,600. So this is critical. You have to always make sure that your total assets equal your total liabilities plus equity. So here is our completed balance sheet. We have all of our assets listed, we have our liabilities and our stockholders' equity, and they all balance out. So let's see. Make sure we call it. Okay, so I think I mislabeled some stuff. I think we have to use the proper. So we have to have a subtotal of 20,600, and then let's see if that does the trick. Okay, so if you notice, all I did was add the labels for the subtotal and it corrected the final label here. In the questions you do for your homeworks, you will not have to type in the answers. There will be just a drop down, so you shouldn't run into that problem.